But now, how do we determine the expenses? Figuring out the revenue is going to be the easiest part of this whole deal. How do we figure out the expenses? Any ideas?
Well, don't we have expenses on the financial statement?
Well, we do. In fact, these are the categories right here. Production and service, equipment purchases, marketing and sales, admin and management. But we have them for the base year. We don't have them for 2020 and beyond. Any idea how we might conjure them up for the future years?
This is related to, go ahead.
So go ahead. No, you can go ahead. That's fine.
It's just, I was wondering if this was related to our constant returns of scale. Do we just use the same percentage?
Like a ratio?
It's an interesting way of looking at it. And as it turns out, we could, and I will beg you not to. I'm going to ask you to think about some other ratios or relationships that we can use in a constant returns to scale environment and in a non-constant returns. Because this model might be reflective of constant returns right now, but the next time you use it, maybe it's not. And I don't want you to have to recreate it from scratch because you didn't like doing that the first time. Okay? So let's think about this. If I know that production and service as an expense, sitting here at 146.802, is some percentage of revenue for a given year, do I have a realistic expectation that I should be able to have that expense category be about that same percentage of revenue in future years? It would tend to make sense. It would follow the constant returns to scale philosophy, and it would tend to make sense. So what I've done is I have created what's referred to as a forecast ratio. A forecast ratio. Let me go back to my my PowerPoint. I want to create a set of forecast ratios that will work off of my revenue to help me forecast my expenses. If I can create, by using my operating expense, any operating expense category in a year, and divide it by the revenue for that same year, it gives me some ratio or percentage for that year, doesn't it? And if I want to then use that ratio to help me as part of a model to forecast future year expenses, all I need to do is take that ratio times the future year revenue, and it will give me the operating expense for that future year, won't it? Let's go back to the spreadsheet. I hope this bouncing back and forth isn't unduly challenging for you, but it's the only way I know how to show it to you in our virtual environment. So I've created a ratio, and I've created it by taking the operating expense category divided by the revenue for that year, just exactly as we've discussed. And now if I want to forecast the expense for that year, I will take the revenue for the year I'm forecasting times the ratio, and it gives me this new expense. So I work off of a ratio that I construct for my base year. The expense category divided by the revenue gives me a ratio. I then operate under an assumption that if production and service was 53.65% of 2019's revenue, it realistically could be 53.65% of 2020's revenue. I forecast 2020's revenue based upon my revenue forecast. I then interact that forecasted revenue with the ratio to get the new forecasted expense. Any question about how I got that?
No, but why do you have to do it per expense category?
Because sometimes expense categories don't all move at the same rate. In a constant returns environment, they will, Matt, but in a non-constant returns environment, they won't.
Like you might have one that just in real world, one expense category might balloon for one particular business reason or another.
Yeah, let's say that one of these expense categories is heavily affected by the price of oil. and oil prices are going up, but labor prices are not. So we want to have as much granular detail as is appropriate for our situation. And let's be honest, what I have done here is we have 4 expense categories plus depreciation, and they mirror our 4 expense categories plus depreciation. I've given a separate category for each one of my expense categories so that I can credibly forecast my EBIT. And by the way, I've got revenue, and I've got each of my expense categories, and I have all of that so I can get to EBIT. But let's continue to look at this for a few minutes. If I could come upon 2020's expense that way for production and service category, I can come about 2021's expense the exact same way, and 2023's expense the exact same way, even 2025's expense the exact same way. Because as long as I have forecast the revenue, and as long as I believe that this expense category is going to be 53.65% of my revenue, I just apply that ratio to the revenue to get the expense. Okay? Now, I want to show you something else, just so you're empowered, and then I want to beg you to not do it. Shenzhen, what do you suppose the percentage change is in production and service expense from year 1 to year 2? If you had to guess, don't calculate it, just guess it.
I think, is it the revenue times the 53%? Is that?
Well, that's how I got it. But think about this. If I get this expense using my revenue and a constant ratio, but my revenue is growing at 31%, what percentage is my expense growing at?
31%.
31%. Now I want you to know that. And then I want you to slap yourself and promise to never do it again, to never use it, okay? Because this works, that relationship only works in constant returns to scale and does not work outside of constant returns. But I want to tell you that because one of you is going to figure it out and then try to use that, and then in a future variation of this, it's going to mess you up, okay? I want you to always forecast your expenses using the ratio. Always forecast your expenses using the ratio, not the growth rate. I can look at my percentage growth and I'll say, well, I've got 251.927 in 21, 191 or 192.311 in 2020. I can apply a very simple percent change formula to that. So 2051.927 minus 192.311, and then divide that by 192.311, and lo and behold, it was 31%. And somebody here is going to figure that out. Don't use it. It's not a consistent estimator unless we're in a constant returns environment, which we will not always be in.
So just to restate that just really simply, Rick, so because we are forecasting, to get the forecasted figure, we want to use the ratio, not the growth rate year to year of the expense.
Yes. Because the growth rate of the expense is the same as the growth rate of the revenue in this case. Okay? Well, we did this for production and service. We could use the same thing. We have a 10.83% ratio, our forecast ratio. Came about by dividing the equipment purchase value for 2019 divided by the revenue for 2019. It gave us the ratio. To find the numbers for 2020, we simply use the ratio times the revenue that we forecast, and we come up with the expense. And we do the same thing for sales and marketing expenses. We do the same thing for admin and management expenses, and we do the same thing for depreciation expense. So all of these numbers are forecasts from 2020 all the way through 2025. 2019 numbers are not forecasted. They came off of the income statement and or the balance sheet, right? Over here, I'm calculating EBIT. How do I calculate EBIT? Carol, any recollection?
Isn't that you take out the depreciation, right? Total cost and expense.
Well, actually, EBIT has depreciation as one of the expenses.
Well, I did it backwards then.
Okay. So what I've done is I take my revenue, revenue, which here is in D13, minus the sum of all my operating expenses. And that gives me my EBIT, right? Notice what I didn't do. I didn't forecast it like I forecasted my depreciation or any other expense. I simply calculated it. Okay? EBIT is not a forecasted column. It's a calculated column. So let's think about some other things that might be calculated as well. No plat is a calculated column. It is EBIT times 1 minus a tax rate. Invested capital is not a forecasted column. It's a calculated column. What's the equation? What's the ops equation for invested capital? Invested capital using the ops approach is?
Fixed assets
Sorry, go
plus
ahead.
net working capital.
Say again?
Fixed assets plus net working capital.
Fixed assets plus net working capital. So apparently I'm going to have those on here. Everything I'm doing, with a couple of exceptions, is all focused towards getting to free cash flow. So all these columns we're talking about so far are simply there to help us get to free cash flow. There's no other purpose for them, because free cash flow is the top of the heap as it pertains to the cash flows when we want to think about valuation and how you make decisions with firm assets. So let's keep going with this. I bypassed interest expense, which I'm going to continue to bypass for a few minutes. I'll come back to it, I promise. But if you can forecast revenue, by the way, I'm going to bypass debt, but I'll come back to it. If you can forecast revenue, if you can forecast your operating expense categories, and you have to forecast all of your operating expense categories, you can't leave anything out, then you can calculate EBIT. And EBIT's important because if you know EBIT and if you know a tax rate, which our tax rate came from our financial statement, right? If we know that, then we know no plat. And if we know no plat and we know EBIT, if we know no plat, we know depreciation, we know the first two terms in the free cash flow equation, don't we? Thank goodness. To get to the next two, which is change in net working capital and net capital spending, we must have values for net working capital and for fixed assets, because net capital spending is fixed asset from time one minus fixed asset from the time before plus depreciation. So we've got to be able to forecast net working capital and fixed assets, which means we're forecasting the balance sheet. All of these other categories we've been forecasting are from the income statement. We got to forecast the balance sheet, which isn't necessarily as hard as you might suppose it to be. Here's a relationship you can count on, and this relationship is, I have observed this hundreds of times in small businesses that I have worked with, and I've observed it hundreds of times in looking at large businesses that are publicly traded. If you looked at the 100 firms in the S&P 100 and the 30 firms in the Dow Industrials, you would find that the invested capital of those firms tends to grow at the same rate that the revenues grow. The invested capital grows at the same rate that the revenue grows. we would like it to be different. We'd like there to be a faster growth in revenue than our capital base. That would give us increasing returns to scale. But we typically don't observe that. Very small companies, very big companies, we tend to not observe it. I'm not even going to venture a guess at the moment, although we'll talk about this in a few weeks. I'm not going to venture a guess at the moment as to why we observe that, but we tend to observe it. Okay? So I want you to think about that as a constant. So if that's the case, then what is the inference and how do we forecast net working capital and fixed assets? Well, first, how do we forecast them? Well, if we have seen that they tend to grow at the same rate as revenue, then let's expand them at the same rate as revenue.
So just times that percentage of like, what was it, 31%?
In this case, it's exactly right, Bella. So in cell D20, and you can't see it because I've tried to make these big enough for you to read, but over here in cell D20, you see we have the 31% forecast of our revenue. It's the same forecast of our revenue I had up here, right? I'm just repeating it so I can see it again. So I like looking at it for some reason. So I'm going to grow my fixed assets at the same rate, I'm going to grow my fixed assets at the same rate I'm growing my revenue. There's an inference here that's important. Let's see, who have I not been picking on? I haven't picked on Kate for a while. Kate, you've got McConey Printing Company. Okay, am I pronouncing the last name correctly, by the way?
Sure.
Cool. McConey Printing Company. And you believe that this next year you can double the number of printing jobs and output that you've been that you had the year before. So double the number of books, flyers, marketing posters, whatever you're printing for your customers, menus. Do you think you can do that without doubling the number of printing presses? By the way, you're already operating at full capacity.
No.
You can't, can you? 93% of the companies in the marketplace grow their revenues based upon a growth in their operating assets. If I want more prints, I need more printing presses. I need more people to operate printing presses. I need more square footage to put more printing presses in. I need more electricity to run more printing presses, and so on and so on. Okay? 93% of the companies in the marketplace. The revenues are a function of the productive uses of their assets. The revenues come from the assets. Somebody was asking me about CFFA a day or two ago. I think it might have been Diana. Cash flow from assets. Diana, 93% of the companies in the marketplace create their cash flow by the management's effective use of the assets. The printing presses, the trucks, the warehouses, the technology, etc. So as the revenues grow, or rather as the assets grow, the revenues grow at the same rate. That happens to be a condition of constant recurrent returns to scale, by the way. Okay? So here, I'm projecting not net capital spending. I'm forecasting. Not net capital spending, but I'm forecasting fixed assets. And if I have forecast fixed assets, then I know I can take the change in fixed assets, which is fixed asset from time one, minus fixed assets from the year before, plus depreciation. That's net capital spending. And I now have the third component to free cash flow. I had no plat, I had depreciation, and now I've got net capital spending. And the next one is super simple. It's change in net working capital. Well, net working capital are my current assets minus my current liabilities. And net working capital plus fixed assets equal my invested capital from the operations approach. And if I know my net working capital for 1 year, and if I know it for the prior year, I have a change in net working capital, don't I? Which was the fourth element of free cash flow. So here I might say that I have free cash flow, and it's going to be no plat plus depreciation minus change in net working capital minus net capital spending. And it gave me free cash flow. As it turns out, fixed assets are growing, so I'm expressly forecasting them. Fixed assets are growing at the same rate as sales. Net working capital is growing at the same rate as sales. I'm not forecasting no plat or invested capital or EBIT. I'm calculating them. All these other things are growing at the same rate as sales. Sales are growing at the same rate as sales. I have a constant returns to scale environment, and I can look at my percentage change in any one of these elements, and it is the same as my percentage change in sales because of some of these assumptions I've made that require or that end up in constant returns. Does that make sense? If you practiced it a time or two, which you'll do, could you come up with, given some values, some market expansion, some macroeconomic conditions, do you think you could come up with an expected growth rate in revenue? If we gave you the inputs, you could, right? If I said Mario's market is growing at 10%, and Michael Schwartz has come in and put together a growth plan for expanding some facilities well beyond what the market does, and Kylie's come in and said she's got some new products coming out of R&D, we could come up with a number in the same way we came up with this 31%. Well, it might be a different number, but our methodology is what's critical to us here. We almost don't care about the number at the moment. We care about the method by which we got the number, right? If we could come up with all of those and these forecast ratios, we could come up with EBIT. And if we can come up with EBIT and we know a tax rate, we came up with no plat. And if we know that no plat is equal to, if fixed assets plus net working capital equals invested capital, I now have no plat and I have invested capital, which means I have ROIC. I've closed my circle here. And I was able to get free cash flow at the same time. And if I can forecast my free cash flow, can I identify the value of the asset? The asset's value is the present value of all expected future cash flows discounted for rate and time. What rate did we use? Or are we going to use and not tonight, we'll use it another time? WACC, which came from the other financial statement. I'm building a model. I'm being redundant with a lot of my utility here, so I don't have to calculate things over and be yet more redundant with my math, right?